Welcome back to whatever week of social distancing this is. Like many, I've lost track, but I do know this is week 4 of the Online Investor's Guide to Thriving. Our mission, as always, is to help you do better with your money so you can live your best possible life while sleeping at night. If you want the same, and it's a safe bet that's why you've joined us on the webinar today, let's talk about the point of all this. Why are we investing? Why did you work hard to save up capital to invest in the first place? What's your money for? If you understand the answers to these questions, then you can begin to understand the kind of risk you need to take in markets to make it happen. So when the occasional massive global financial crisis hits, it's natural to wonder, am I still okay? Am I going to be all right? But really, this question comes up time and time again. Today, it's COVID. But to quote Donald Rumsfeld, there are known knowns, things we know we're going to encounter in life, and there are known unknowns, things that we know we don't know, and they're coming. Financial curveballs and transitions are part of life. You've probably already dealt with some, and you're going to continue to deal with them. So the question is, are you prepared, and who's in your corner? If you're one of the 60% of Canadians, approximately, that have a financial plan, good for you. But the thing about plans is they become obsolete not long after they're created. That's why we prefer strategies to plans. Strategies are living, breathing things. When something changes, you change your strategy. So if we're talking about investing, how to access your investments to fund spending, how you hold your assets, how you minimize taxes, and more, the world never stops turning, and your financial strategy never stops pivoting. When Larry and I started ETF Capital Management in 2006, we focused exclusively on asset management. But since then, we've evolved 2 distinct ways of working with customers. First, as many of you are familiar with, we manage ETFs and funds of ETFs in partnership with BMO Global Asset Management. You can learn more about these at zzzportfolios.com, and they're available to you at any financial institution. Now, we also provide private wealth services to clients with investable assets of $1 million and up. So it's not for everyone, but this arm of our business has changed considerably over the years. So now we focus just as much on financial life strategy as we do on sleep at night portfolio management. You can learn more at etfcm.com, but later this month, prompted by a lot of the questions that we've received, some of which have made past webinars and some of which haven't. So we've collected all of those up, and we're going to address them on April 28th. You'll have the opportunity to join another webinar with Monique Madden, who's our head of financial life strategy. And she'll discuss the things you can control and what you can optimize about your strategy in difficult times like this. We can't control what markets do, but there's still plenty of levers you can pull and ways to manage risk to keep you on track to live the life that you want now and in retirement. You can register for this webinar on upotential.com, which is our fee-only financial planning company, or by opting in on the survey you'll receive after tonight's webinar. The same survey is your gateway to catch the replay of tonight's webinar with Larry or to download Larry's slides. Once you complete it, you'll get access to both links. If you want to catch Larry on BNN, he should be on tomorrow at 4:30 p.m. and again next Friday on April 24th. We've noticed BNN keeps moving the show around, so the best way to find Larry's past shows is to visit his blog, BermansCall.com. We post all of the clips there. Now, Investor's Guide to Thriving comes to you at no cost in favor of 2 causes that Larry and I believe in passionately: sick kids and the Baycrest Foundation. We hope you can join Larry and I in supporting childhood leukemia research at Sick Kids. And also, we appreciate your support for the groundbreaking work being done at the Baycrest Foundation into the treatment of Alzheimer's and dementia. For those of you who have made donations, thank you very much. If you would like to make a donation, please use the links in the survey that you'll receive after this event. It's important to use those links because Larry and I match all donations, and that's how we know who's made a donation. Thank you also to our sponsors, National Bank Direct Brokerage and BMO ETFs. BMO has been our partner in ETF education for over 10 years, and not many people do it better than Mr. Kevin Prinz from BMO ETFs.
Thank you very much, Jared, and I'll just jump right into it because what today I want to do is spend just a little bit of time talking about portfolio construction in advance of Larry's overall conversation. And what I want to just kind of show you is kind of a context, first of all, the economic cycles is an example here. You can just advance to the next slide if you can there. Perfect. And what I'm trying to show you here is when you're looking at investing in different parts of investing, there really is different cycles to investing, whether it is the recession, recovery, slowdown, late recovery. I mean, ultimately, as investors, you have to figure out yourself where you think you are in the respective markets, or hire professionals to do that for you. And when you look at that, you can also look at what style of investing you should be in during those periods of market, because some styles do better than other styles in the marketplace. And then, of course, you can look at different size, whether they want to be large or small. And then, of course, the various sectors themselves in the marketplace. You know, a way of thinking about this, and if you can advance to the next slide here, is really take a look at the various ways of building a portfolio. You can look at building a portfolio based upon pure broad beta. You know, whether you want to hold the broad S&P 500, the TSX cap composite, and some broad fixed income together, you can certainly do that. You can also look at a style of investing called factor-based, and quite often known as value or growth or momentum in the marketplace, and rotate amongst those. Beyond that, too, you can also look at maybe sectors in the marketplace and move between various sectors that do well in different times in the marketplace itself. All those are different approaches to building your portfolio and effectively managing your portfolio across the board. Now, I will highlight, like that sounds very simple. And let me trust you, this takes a little bit more than that, and you won't be able to cover all that in the next 10 minutes I cover this off with. But it is a way to get you started and get you thinking about how to build your portfolio, whether you want to start with a core holding and bring in some factors and some sectors to really complement your core holding across the board. Let me just advance to the next slide to give you some ideas what I'm really talking about here. You can look at building your portfolio based upon your conviction in your decisions. So if you have high conviction in your decisions, maybe you're more into the satellite aspect. But if you don't have high conviction in your decisions, maybe you're more in the kind of the core aspect there. So you look at more of a satellite and core. And inside the satellite aspects, you can take a look at whether you want to bring on risk or reduce risk. Using broad beta is kind of that middle aspect of building a portfolio. So reducing risk on the far end would be like a low volatility strategy. And then the other side, if you want to bring on risk, would be more of a value approach out there where you're got more enhanced value. Ultimately, in either way you look at that, these are just ways of building a portfolio and bringing on satellite exposure. For kind of a core, I'm just using a simple example here. You can use like a Z-BAL. There's others in the marketplace like a V-BAL, the whole works out there. But ultimately, these are traditionally, a 60-40 mix of the overall marketplace. Not going to spend a lot of time on the core because I want to talk about really enhancing it across the board. So for an example of enhancement, you can look at sector rotation. Now, when you're looking at sector rotation, you want to also think about where you want to be, where you think you are in the market, whether it's an early recovery, a mid-cycle, late cycle, and recession. And these are just examples of different types of sectors that maybe you want to lean into. So if you're more in the recession, you want to be more defensive in nature, that's your utilities aspect, and you're more of your staples. If you're more in the early recovery stage, maybe you're moving more the banking sector and moving a little more risk on there, or discretionary for that matter. But you can use a core and explore with sectors to really bring risk on and take risk off across the board. Beyond a sector approach too, if you want to move into more of a factor-based approach, you can do that too. And I guess I should highlight that you can do all this with ETFs. Ultimately, with factors, what I'm really talking about here is different ways of looking at investing in a broad market. Now, when you look at the broad market, you can still have US, you can still have international, you can still have emerging markets for that matter, but maybe you want to have more of a value approach in a recovery place. But in maybe the late cycle, the recession, maybe more of a quality approach. And when you're talking about quality, you're talking about companies with good debt to equity, good stability of earnings, basically a lot of cash on hand to effectively reinvest going forward. So those are more stronger companies to ride through the storm. And then, of course, maybe here in the recession-wise, maybe more low volatility to mitigate that risk. But what I'm really trying to highlight here is you can look at ways of taking on risk or taking off risk beyond sectors, but actual factors themselves. quality maybe not be a bad approach. Some of those companies out there with the cash on hand may have some opportunities too going forward beyond just the early cycle. But it is important for you to do your own homework around this because portfolio construction takes time and takes effort. We did give you a little quick chart here kind of highlighting that over time you do see factors do change in value across the board, and sometimes they're leaders and sometimes they're laggers based upon different parts of the market itself. And then quickly to highlight, that's not the only considerations you really want to bring in the marketplace here, because if you're looking at just portfolio construction, you want to bring in things and thought processes like currency. And again, you can put the currency hedge on or take the currency hedge off based upon your views in the marketplace and your desire for diversification. You can certainly look at different geographies too. Maybe you want to have more China right now, or maybe you want to have less China right now. You can do that with your very respective ETFs. Of course, a lot of people want to look at income out there because that's a more of a financial planning conversation. Certainly, you can look at ETFs that tilt towards income, either the dividend kind of approach, or even enhance that with a cover call approach. And last but not least, of course, always think about tax and tax efficiency too when you're building your portfolio. This is just a quick little overview of what you can do in building a portfolio and kind of giving you a thought process of starting with that core and bringing some explore around that, whether you want to use sectors to explore or individual factors to explore. You're going to have to do your homework beyond that. Now, if you want some insights in the market going forward, I'm just going to simply highlight we're doing a partnership with TMX. Happens every Friday at 1 o'clock. We'll send you some information about that as part of the survey that goes out at the end of this webinar. Thank you so much. Let me hand it back to Larry and let you go from here.
All right, thank you very much, Kevin. We love partnering with Bank of Montreal for lots of reasons. One, I think they have an outstanding suite of ETFs. Obviously, I run one of them with ZZZD, but really they focus so much on investor education, and I know many of you are tuning in for that piece tonight. So, as we sit here, futures markets are, I say, ripping higher. Starting at around 4 o'clock, there was a series of headlines that had come out. One was President Trump's three-part plan and really turning power over with a bunch of guidelines to the states. I think and I hope we see that here in Canada. It's really important that our leadership makes the right calls on our behalf here in terms of getting everyone back to work. Like nobody wants to be sheltered in place forever. Economically, if we have to do this for another 6 months, it could be catastrophic on lots of different levels. If you talk to social economists and things like that. So we do need to get back to work, and this is very important. Just before 4 o'clock hour, Saudi Arabia came out and said, we're willing to work with Russia even greater degree to control the imbalances in the energy market. So you had two things kind of hit. And then just after 4 o'clock, you had a study that was coming out of one of the Chicago hospitals where they were using the drug remdesivir in some clinical trials. Now, these are non-controlled trials. They had no placebo. They weren't done according to all the rules that you would like to see in trials, but under an emergency basis, this drug was given to a bunch of COVID patients, and they had very, very remarkable results. Some people still died, but a lot of people came off their fevers and were been able to take off ventilators far earlier. So the marketplace is seeing this now as a very, very good sign. This is not a cure. This is not like people can take this drug and not get COVID. People will get this drug as a viral treatment once they're into severe respiratory damage in hospitals and ICUs. So the market's very excited here. We were always going to get a face-ripping rally. Small cap stocks are up close to 6%. The S&P 500 up a little over 3.3% right now. NASDAQ up about 2.4 and so forth. A lot of individual stocks that are linked to people getting back to work and stuff are rallying, and some of the defensive hedging stocks like gold, for example, are selling off a little bit. So the markets are fluid, folks. They're going to be changing by the day, by the hour. My talk tonight, notwithstanding, still allows us to deal with all these things. So I'm going to talk about, again, what keeps me up at night. Those of you who have been on past weeks, a handful of the slides are the same, but I've always got some fresh material. What I want to talk about is money creation tonight, and what some of these extraordinary policies are going to mean, and a little bit about the post-COVID world. These are new things that I want to kind of think about and talk about and get a general discussion going on, and as much as possible answer a lot of your questions tonight. So what keeps me up at night, this has been the problem for a long time here, folks, and it's what I've talked about every week and for the last few years, and why I've been so defensive in portfolios. There is no bottom line growth in the taxable amount, what's called GAAP earnings, that people, that U.S. corporations are paying for. Now, it doesn't mean markets can't go up, because clearly they have. But a lot of what's gone on in the last number of years, and you can see it in the graph on the right here. I clipped this chart from my daily report that my good friend David Rosenberg at Rosenberg Research was so kind enough to let us borrow and use. And that is looking at the non-financial corporate debt outstanding as a percentage of GDP. And what we can see here now is that the shape of US balance sheets has never been worse. And it's the precursor for the deleveraging cycle that comes with every single recession that we've ever seen. There's a period where corporations under duress need to get more defensive. One, because they can't refinance their debt in the free-flowing markets, so they have to issue equity to buy back that debt. And the corporations that are going to pay the dearest are the ones who really abused the process. So I'm highlighting the stocks within the S&P 500 buyback ETF that's been around for a number of years now, highlighting the underperformance of this group of stocks. These are the companies that have been leveraging up their balance sheets to buy back shares. And frankly, it makes me sick that the airlines in the US, the worst culprits here, are getting bailed out by the tax dollar, where they were so abusive to enrich the C-suite in terms of leveraging up their balance sheets using free cash flow. So when a corporation has a profit, EBITDA, earnings before interest, taxes, depreciation, amortization, and you're the CFO of a company, what do? And in this era of low interest rates, and at the expense of giving back the money to shareholders by way of dividends, by way of taking that free cash flow and investing it productively, not in the stock of your own company to boost earnings per share, but in people, in new capital, new equipment, in research and development to grow your product line. And the fact that they haven't done this and they've bought back their shares at record prices. Look at this graphic on the right here, folks. It was put together with some data through a Canadian firm, Canaccord Genuity. When they look at the amount of buying that's gone on, that's come from companies buying back their stock purchase, so net buybacks, compared to the buying of stocks that came through ETFs, through foreign buying, through insurance, through mutual funds, through dealers, through pension plans, etc. There's been no net new buying going into all these asset classes that are real and it's all been largely share buybacks. Folks, that has accounted for about 800 points of the S&P gains over the last decade. So the real high that was 3,400, to me, is really 2,600, because we're not going back to the days where the C-suite is unchecked. I believe this buyback is going to become a big political issue, and I encourage you to understand kind of what all that means going forward. Now, the Fed has gone all in. You know, back in March, before the market bottom, they announced a massive plan. April 9th, you know, a week ago today, when minutes before the weekly employment claims came out, they announced an all-in, basically an unlimited degree of support, including and illegally setting up a special purpose vehicle to buy high yield debt. So there's almost no limit to what the central bank balance sheet will not try to accommodate to facilitate liquidity. And folks, this is needed, because if they didn't do any of this, I don't know where the markets would be today. But having said that, there's some implications. From an investment standpoint, the biggest implication of the size of the Fed balance sheet, which is currently, as of the snapshot, is a little over 6 trillion. Remember, in the fourth quarter of 2018, the markets had a bit of a stroke as the Fed wanted to normalize the balance sheet. They're never, when I say never, I mean never. They're never going to be able to get off this QE. And the question then becomes, is this bullish? Because it was thought to be bullish for equities, because there was no alternative. And what we saw when people just willy-nilly went and bought stocks at ridiculous valuations because of the fear of missing out. And a few questions came in, and one of them in particular said, "It's making me sick watching the market go up on bad news." You know, that folks is an emotion that you've got to control. If sitting in cash, folks, triggers that emotion of fear of missing out, you're going to make all kinds of terrible mistakes with your investing. And that's why I say actually selling out and going to cash is probably one of the dumbest things you can do. But if you have no emotion about investing, then it's absolutely fine. But 99.9999% of us have emotion when it comes to in decisions about our money. So it's about how much risk do you take at any point in time. And that's what I'm all about, trying to deliver a smoother ride, trying to, when the risk factors are high, take less risk, and when the risk factors are low and there's value, take more risk. That's really what I'm all about, and what I try to teach people in a lot of these educational formats. So one of the things that we're going to see, and that's been talked about by the Fed, is yield curve control. I put a link on the post here. Liberty Street Economics is a research group, part of the New York Federal Reserve. They put out excellent research papers, and they put out one this week that went back and said the last time we had yield curve control, and I'll explain the graphic in a minute here, was to fund the massive debts that were accumulated during World War II. And they lasted for 5 years past the end of the war. Folks, I'm calling this World War C, right? This is not World War III, this is World War C, the coronavirus war. And we don't know what it's going to look like. There's so many things here that are unprecedented. But what the central banks will need to do, which is immensely bullish for gold, is to peg interest rates at a certain level, because at some point here, all this largesse, all this money spending is going to create a tremendous amount of inflation. Initially, the economic shock is deflationary. But ultimately, the medicine is very, very inflationary. And I'll talk about that a little bit more at the end. But my BermansCall educational segment tomorrow is a little bit on yield curve control and what that ultimately is going to mean. But in the graphic here, I'm showing the US yield curve and the yield curve for Europe. And we're going to see anchoring. It's already in place in Japan and Europe, where they said basically yields get above a certain amount, we're going to buy them. So that's coming to the US as well, and Canada for that matter, because Canada will do what the US does ultimately, or we risk spread erosion, which is something that Governor Polo's talked about in his comments this week in terms of fixing interest rates. But the debt to GDP, as you can see here, is going to rise. And a lot of that debt, folks, is going to end up on the balance sheet of the central banks, which is inherently bullish for gold. So back to our 2008 and 09 playbooks. So I heard a lot of feedback, Larry, you're too bearish. You know, it's not about that. It's about understanding the environment and how much risk to take given factors of risk. And so the 2008-9 playbook in my mind is still playing out. And it's still playing out very, very well here. So I think, and it looks like we saw the spike in fear, but that does not mean we can't keep going lower in price. Now, the market will have to digest what remdesivir means. It's going to have to digest what the opening up of the economies are going to mean, but it's going to be slow and measured. This is not a light switch. This is not a V recovery. The economic damage from this shock and what's still to come in the number of months is not priced into the current market. And I don't know where the bottom is, okay? Lower, more than likely. When do we get there? How long does it take? I don't know. But the playbook here is still very real. Someone asked a question the other day, Larry, the VIX dropped under 40. Is it a buy signal? So the answer is no. And so I talk about VIX being a good indicator. So the bottom is not in until VIX significantly drops below and holds below for a week, 2 weeks, 3. But you can see here what VIX did back in 2008-9, which is the upper graph. And it did drop below 40 in early January for a couple of days, and then spiked up again and spiked up again. Never got back to the extreme 60, 70, 80s that we had seen on the past spikes. So the markets are getting used to it, are used to the surprises, are used to the noise. So they don't price in that implied volatility, but prices still kept going lower. So it's that kind of pricing in the economic damage that we've got in front of us here. Do not use stops, scale in and out, use limit orders. Those are very important execution skills in terms of understanding how to trade here. I've actually noticed in ZZZD, people are putting in market orders to buy and sell. Don't do that, people. You've got to use limits. You're going to get whipped around by periods of illiquidity, which when volatility is high are inevitable. You've got to learn that. So when risk factors are high, add more alternatives. I add more things that mitigate risk in your portfolio and can still generate returns. So the CNN Fear and Greed Index, I am creating a BermansCall version of this, which I hope to be ready before it's not, but it's not a first priority for me. It will take some of these indicators and it'll publish them, but right now you can go on the CNN website and see this for yourself. And when the risk factors are greed and extreme greed, be cautious. Buy the ZCON ETF, use a bit more cash. Go to things like low volatility, like Kevin talked about the economic cycle, because you don't know when it's going to start. But don't get caught up in the fear of missing out. It's stupid. I don't know how to say it any nicer. It's not prudent. It's not cognitive behavior. It's not thoughtful. It's very, very emotional. And you don't want to get there. So when the risk factors are high, take less risks, so that when the panic and fear is acute, you can take advantage and buy things cheaper. It's the only, in my mind, folks, it's the only way to think about it. Now things have neutralized, all these Fed programs. So you've seen in the last few weeks, okay, you've seen a change in sentiment on the street. You really have. But what we haven't priced in yet is the economic fallout and earnings. And so when when the recession first started in 2008, so this pink area that's shaded here, the markets took almost 2 years before they bottomed in terms of earnings. The economic shock in terms of the hit to earnings is in front of us. And we don't know, we can't know. Folks, this is the worst economic shock in history. To think that anybody knows, it is laughable. It really is laughable. So I do appreciate your questions. But what I can tell you factually, when there's no recession, the average correction is about 13.5%. And you always want to be buying dips. But when there's a recession, the average correction's 30, okay? 29 actually. So you want to start to think about buying down 30 at the recent lows. Some things were down 40, some things were down 35, some things were down 30. That was when you want to think about it. But what I'm going to show you in a couple charts from now is how to deal and what may be coming in front of us. Not will be coming, not for sure, may be coming. But earnings won't recover for 2 to 4 years at a minimum, okay? And at the worst case, the bottom of 666 for the S&P 500 was with earnings expectations of about $60. You can see the orange line there is expected earnings, and a multiple of 11. That was 666. So, where is this going to bottom? Okay. So that's really what we have to figure out here in terms of earnings. Now, only until recently have earnings started to really be downgraded and thought about by the analyst community. And as banks have reported here, they've been terrible and so forth. So you've got an element of emotion and news flow swinging the fast money, but then you've got the fundamental reality of what base earnings are really going to be. So at 27.90, forward earnings now, I didn't update this graph, I missed that quote there, but you can see in the graphic 19.3. So we're now trading at 19.3 forward earnings. That's very expensive, people. Again, compared to 11 times forward earnings at the bottom in 2009. So again, I don't know where it's going to be, but out of that trailing earnings that's in the bank, 151.96, that's what we earned last year. Okay, and now we expect this year to be down a little bit. It's going to be down way more than that. We're not even close to being done there. But the long-term fair value is 15 to 16 times, and those saying it should be higher because rates are wrong are wrong. Rates are low are wrong in my opinion. Okay, rates are low because the world is unstable, and the global economies can't handle normalized interest rates and won't be able to for decades. Okay, we should not be paying more for that. We should be paying less, in my mind. 30% of earnings per share aren't real. 10% have been share buybacks. 10% are BS earnings, pro forma, non-GAAP earnings, and 10% were the Trump tax cuts, which will be reversed by the Democrats should they take over the White House, because we have to pay for all this, okay? And we're going to have to pay for it heavily. And whether it's us, our children, or our grandchildren, somebody's paying at some point. Now, in 2017, those gains were FX related. So there's a lot of earnings that are in these numbers that aren't real. And so what is that base rate of earnings? Okay, we'll get to it. So sleep at night portfolios, folks, again, reiterating what I'm trying to do for you in ZZD is seek the best source of yield around the world. Dividends where it comes from interest rates, or dividends, or when you get a dividend for a non-Canadian source, it's treated as income. You don't get the benefit of the dividend tax credit. So this is not a Canadian dividend fund. This is a global sleep at night dividend fund. And the standard deviation, the volatility of our portfolio. So when I talked about VIX at 80, that's a standard deviation. That's a daily trading range of 5%. And a VIX of 40, close to where we're sitting now, is a 2.5% daily trading range. A VIX of 15 is 0.93. So the world index, VT, in the history I've been running the BMO Tactical Dividend Fund, and in the last year and a bit, ZZZD, which is a unit of the fund, the benchmark has a standard deviation of 0.83. So that's a VIX of around 14. A VIX of around 10 is 0.63. I'm running this portfolio generating better returns than the market with an average daily range of 0.48. That's what sleep at night means, okay? And so when we look at the 3 BMO funds that I run, one of which is the Tactical Dividend Fund, which is available in ETF format. There are versions of the funds that you can buy in mutual fund format that have the same MERs as ZZZD, very low, around 70, 75 basis points. You can very simply, for 18 basis points, buy ZCON as a conservative 40-60 balanced portfolio. You can buy the ZBAL 60-40, very conservative balanced portfolio, globally diversified, or if you're a growth investor, an 80-20 ZGRO. And when the CNN fear and greed index is higher, simply switch to the ZCON. And when it's at a low level, go back to balance. Well, like whatever's right for you, folks. I don't know. I don't know you guys. And that's why you need a financial plan. Because having a financial plan with a good independent financial planner who doesn't make you buy something from them is probably one of the best things you can do. But if to find a good planner, it might cost you $2,000, $2,500. A real good planner, if you have a complicated business structure, could be $5,000. And not a lot of people want to write those checks. But folks, I'm telling you right now, one of the best spends you can ever have if you have a good planner. And that's where Jared mentioned the webinar we're going to be doing with Monique. She's fantastic, works with us. And for some of you folks, that could be 100% equities. I have no problem whatsoever, given where interest rates are, for some people who can handle more volatility to have 100% equity in their portfolios, but not when the multiple is 20 times earnings. Because at some point, you're going to have a shock and a bad experience, and you won't be able to handle it. So the 3 funds I manage, the balance fund as of yesterday's close was up on the year. Not too many balance funds that are up on the year. The benchmark for that, which is ZBAL 60-40 Global Balanced, was down 5.4%. And the BMO Tactical Growth Fund, down 3.69, with the benchmark being the entire world index, the Vanguard Total World ETF, down 18. And the Tactical Dividend Fund, which leaves me exposed a little bit more to equities more of the time because I got to get that yield, and its benchmark down 26%. So that's sleep at night, folks. It's not eliminating the downside, okay? So great things for you to consider if those are some of the things you want to buy. So nobody knows where the bottom is going to be. Again, should I sit in cash here? Listen, if you want to, but then if you have that anxiety, what if it keeps going up? What if we're wrong? What if the market keeps going higher? What if the bottoms are in? Goldman Sachs told us a few weeks ago that we were going to go below 2,000 on the S&P. David Costin, who's their chief strategist. And on the 29th, Goldman says the market will turn lower again On March 20th, the bottom was in, folks. The bottom was already in. On March 29th, he said it's going to turn lower again, and it won't bottom until these three things happen. A few days ago, you can see the headlines here. 2 days ago, CNN, Fox Business, Yahoo. Why Goldman Sachs now says the market bottoms in. Folks, people who are analysts and don't run portfolios, which I was once upon a time, you change your opinion. Who cares? You're not running any money. You're not responsible for risk. If you're listening to people who don't have their own money at risk, or as a fiduciary on other people's money, their opinions, to me, you have to downgrade those opinions. They still might be right, but you have to downgrade those. People who have money at risk, like myself and others, if I'm wrong, people are going to take money out of the funds. I'm not going to make money for me and for my family and for my clients. So the opinion, it needs to be qualified a little bit. And this is Goldman Sachs. And I'm not trying to pick on Goldman Sachs, but it was so overt. And it reminds me of a conversation I had with a very good mentor of mine, a guy named Ralph Acampora, who was an elf on Wall Street Week, and he was a Wall Street technical analyst for decades. He's now retired, but he's still on CNBC once in a while, and people like what he has to say. And I said to him, I said, Ralph, running money, even when I was a prop trader at CIBC, I was only responsible for my P&L. I didn't have to explain to anyone else but the risk manager and my boss why my positions. I don't have to justify it to thousands and thousands and thousands of clients all across Canada. And I do now. And so it's a very, very different kind of thinking. So and of course, as a media figure on BNN. And so I love the educational process. I love teaching about it. I love sharing my thought process with people. And so, here's what I think, and right or wrong, this is my current view. So the fundamentals have yet to play out. And so let's say the real earnings number isn't the 150, and it's somewhere closer to 120. And that might be fair, it might be high, it might be low, I don't know. But let's say it's 120 over the next few years. And let's say the multiple is really a fair number, a 16, not 18, not 19. Remember, because at 120 in earnings, if the multiple's 20, that's 480 S&P points, right? So 16 times 120 is 1920, and that's what I've been suggesting fundamentally as when my shopping list comes out. But I can buy stuff today and hedge it, and I'll talk a little bit more about that in terms of what I'm doing in some of the portfolios. So the opportunity's coming, and you got to be ready for it, because bear markets can unfold in steps, and I'll show you the next chart here on. And rallies are great trading opportunities. And if you're just sitting in cash waiting for Larry's level or waiting for one of these technical levels, we may never hit them. And that's the hard reality, folks. I don't know, and nobody does. And if you don't understand that, you just don't fundamentally understand how markets work, and you'll get left behind. And then the fear of missing out as we go to make new highs is going to kick in gear. And then you're going to be buying it at awful valuations at terrible times because you don't have a plan. You got to have a plan to execute, folks. And so, a couple road shows ago, I talked about the coming bear market. And was it going to be like 87? Was it going to be like 2001 to 2003? Was it going to be like 08, 09? So we don't know, because the current environment has elements of everything. And what we've seen so far has elements of everything. It has an 87 crash because it happened so quick. But the fundamental part of the recession and the bear market is in front of us. Make no mistake about that. Are we going to make new lows? I think so. Am I 100% sure of that? No, I'm 90% sure of that. Before this remdesivir headline that hit, I was 95% sure. So it changes, and it's fluid. But here's how the bear market played out. And again, I think we have a couple years to go here before we ultimately, bear markets don't end, very famous saying, until people are absolutely disgusted and can't stand it and can't, oh my God, I never want to own a stock again. We're not anywhere close to that yet. So we'll see. But we had these monstrous rallies, so higher highs and higher lows, higher highs and higher lows. That's a bull market. Lower lows and lower highs, lower lows and lower highs. That's a bear market. And ultimately, we stopped making lower lows. So is the low we've seen the low? And I don't think so. Okay, for lots of reasons that I've talked about. But you can trade these rallies. So to be invested in my funds, folks, this is what I'm going to do. This is what I specialize in. It's being tactical. When do I hedge the portfolio? When do I buy what I like? Okay, there are things today that we can buy that have okay valuation. Okay, so we can look at some of those things too. There are ETFs like this, the BTAL and the QBTL, that you can own today that is market neutral and can generate returns. It tends to do well when markets are doing poorly. And this is something on a rally that you might want to consider buying, because if the markets sell off aggressively, in all likelihood, this is going to go up. It's not an inverse ETF, it's an alternative strategy. And so when you're unclear, you can, rather than sitting in cash, still make money in different ways. You got to know what the tools are, okay? So that's one of them. I love these strategies. The ZPAY is one of the biggest positions in all my portfolios right now. It's a combination of covered calls and put writing. It takes the best of both worlds. So as markets sell off, you get put stocks, and so you're longer when it's weaker, and when it rallies, you sell more off, all the while generating 5-6% yield. So how is that not great? It has market risks. It's volatile. Purpose has had one for a number of years now. Purpose Premium Yield Fund, that white line. Look at how stable that is, right? Now, it's not a bond. It's not a bond replacement. It's equity market risk. Make no mistake about that. But when I'm seeking yield, which I am right now, this is a good way to do it. So understand what the tools are. This is one of my favorites right now. Here's another interesting one. This is a market neutral pairs trade. I talk about this the last 3 or 4 times as well. This is an ETF where the manager is long one bank he likes and short another bank. So you're neutralizing the sector risk, and you're exposed to company specific risks, what's called idiosyncratic risk. If the analyst is good, they're picking the better bank and the better energy company and the better tech stock, and they're shorting out the market risk. And again, it's not a money market replacement. Money market is the orange line, very little fluctuation, short-term treasury bonds. Okay, this is a long-short strategy, market neutral, that allows you to gain in your portfolio, in all likelihood, better than sitting in cash. Because folks, sitting in cash today, after inflation and tax, it's safe, but it's not good enough, because you'll get left behind. Inflation is coming. I'll talk a bit more about that. I love these buffer ETFs. I use option strategies like this in our private client portfolios. We customize portfolios for individuals. And we do this a lot. And depending on your circumstance, you get different versions of all this funds that we manage that aren't in the BMO world. These are our private client portfolios. And again, if that's something of interest to you, please reach out to us in the feedback mechanism. So I want to explain to you what an option caller is and how it works, and why I can buy things in ZZD and other portfolios and own them today, but hedge out market risk, okay? Be market neutral almost. So an option strategy called a caller is a synthetic short. it's almost no different than actually shorting the underlying. And I use the S&P 500 SPDR ETFs to do this. You can use the underlying index options too. And this graphic here shows that at today's close, this wasn't at today's close because it was at 10:57 this morning when I updated this chart. The S&P SPDR was trading at 278.47, and at the money ETF 278. The puts were trading at 29.54 on the ask, and you can, if you look at line 10 across, you can see the bid ask, and you can see the implied volatility there of that option. And so that was the VIX reading, and this is for December 31st. So I can hedge my portfolio through the end of the year by buying a put, which is 29.54, and at the same time writing the call for at 278, which is 27.47. And the difference is effectively the difference in volatility plus the dividend that if you were short the stock, you would have to pay. Because if you're short SPY and the dividend comes due, you actually have to pay that, right? So shorting isn't free. There's a cost of carry and the cost of paying the underlying servicing fee, the dividend that ETF has. So that's what we do in portfolios. We use the index-based options to hedge market risk, and I can go buy what I like. I like emerging markets. They're volatile. There's sectors that I think are cheap right now, like energy. Okay, I own some of those exposure. I actually like some of the marijuana stocks. So we have some of the weed ETFs in our long portfolio at the moment. There's parts of emerging markets that I really like, and so forth. So I'll talk about my shopping list in a while here. But I can own them and seek gains, but without market risk. So I'm not going to get a lot of gains, like in some of those other portfolios. I'm long and short, but I'm generating better returns than sitting in cash. Now, when the markets sell off, okay, so when the markets sell off and we're closer to lows and better value, I lift the hedges. I'm long a put, I sell it. I take the call that I sold at a higher price and I buy it back. So I unwind the option strategy, and now my underlying portfolio with one trade is exposed to all the things I want to own. So how cool is that? So there's lots of things you can do in your portfolio other than sit in cash if that's something that you actually want to do and learn how to do. Okay, so shopping list. I've talked about duration, long-term bonds. I've talked about yield curve being fixed. What I don't know is what level. So let's say with long bonds trading at 1.25 yield, the Fed decides to peg that at 1.5. Then buying long bonds here is not a good trade. But what if that's pegged at 75 basis points? Then it's a great trade. But I don't know. But what I do know is when stocks sell off, bonds are a great hedge. Not short-term bonds, not money market, but duration, because that's where you get the price sensitivity. So in the blank check policy world that we're in, long bonds are still very interesting. I don't own any right now. And when I do own them, I'm going to own them by way of option strategies that will allow me to create a structure that if bond yields back up, I buy them at that yield. But if they rally, I can still participate in the upside. Okay, so there's lots of different ways to structure options, and I love them, and we use them in all our non-BMO portfolios. In the BMO portfolios, I can do callers. This was a new thing that was just added just a couple weeks back. And what you will see in ZZZD and the other portfolios is very, very little price volatility with me owning the things that we ultimately want to own. Again, where's the world going to emerge from this crisis and this pandemic? And I think the growth places are not going to be in the places that are grossly indebted. I think they're going to be in the economies that are young and have bandwidths of growth for the coming decades. And I've highlighted places like India, frontier markets. While South Korea isn't young, I think it's much better, in a much better place than Japan. And I would tend to want to avoid Japan a little bit and overweight South Korea. Very similar economies, generating technology and distributing that technology to the world. Vietnam, Thailand, I don't love their political leadership necessarily, but structurally they're set up for supply chains to China's Silk Road and therefore, and broad emerging market exposures. There's lots of ETFs and different ways to play that as well. So I like emerging markets coming out of this. So I do think that this massive amount of debt is going to keep us in a low growth world. And for those who want to sleep a little bit better and want less volatility, but need the yield to live off of, but can handle some volatility, the PYF and the ZPay are good alternatives. Like ZZZD is. ZZD is far more adaptive than some of these, and I own ZPay within that, but I can own so much more. So there's lots of good tools. You just got to know. If you're looking for things to short, single company names, these are companies that have been bad abusers of the balance sheet, and they will get punished going forward. They'll rally, they'll trade, they'll be short covering, but they ultimately will trend lower. Lower lows, lower highs, lower lows, lower highs over time as the market punishes them, and they have to spend a lot of their equity to buy back their terrible, terrible balance sheets. Technology, cybersecurity, Internet of Things, robotics, clean energy, emerging market technology. A new one, ARCG, which somehow didn't get put on this list, but I have it there. ARCG is genome tech. So there's lots of great things to own. I'm worried about the coming inflation issues, and I'll talk about those in a minute. So inflation index bonds are going to be key, and I think you don't want to be passive. You don't want to just be sitting in cash. You want to trade the volatility here, but only do so if you're equipped to not let the emotions drive your decisions. So some thoughts on the post world here. So this is the greatest pandemic of all time. So the last one was 102 years ago. We have much more modern technologies today, and so we're not going to lose 75 million people. There will be deaths for sure. It's the greatest economic collapse since the Great Depression. At the same time, the greatest hit to oil demand ever. And we've had the greatest amount of government, central bank and government intervention of all time. To think this is a V recovery is absolutely insane. This is the biggest unknown forever. So one of the biggest structural problems that I've always thought, and I've talked about for years, I did a BermansCall episode about a year back, maybe, on the Gini coefficient, the Gini ratio. And that's the measurement of inequality, the haves versus the have-nots. And in the United States and other places in the world, developed world, inequality is the biggest social problem we have. And a lot of people that have been hurt by this are your hourly workers. These are the people at minimum wage that, yeah, they're going to love the check with Donald Trump's name on it, but ultimately have lost their job. Because if you don't think every company out there that's been able to furlough and lay off people, if you don't think they're going to rationalize who they hire back, you're insane. They're going to look at their workforce and the workers that were not productive, they're not going to be hired back. And this is a great opportunity at no cost, because it's not going to cost you severance, to not hire people back. And so unemployment's not going to come back like a V. It's just not. what we will end up seeing is the populations will be getting madder and madder and madder. And if you think the March on Wall Street after the last crisis was bad, this is going to be worse. Policies to boost stock markets are going to only increase inequality, and we are going to see more and more and more political shifting to the extremes. But we are going to ultimately see more and more left-leaning policies that are going to be designed to tax wealth, lift the bottom half, because inequality, folks, is the biggest problem. Labor's share of the economy has not been this low in forever. Coming out of World War II, labor's share of income, of wealth, of income, was, and it's been in decay for years and years and years. And a lot of it's technology, a lot of it's outsourcing. The good labor jobs, the unionized jobs have gone away. And as supply chains come back, a lot of what Trump talked about in bringing back the jobs, they're going to come back now, not because of Donald Trump, but because of the realization that we can't make needed drugs. We rely on other economies that we have no control over. And so a lot of things, every business is going to be rationalizing. So this is going to boost costs, and incomes are going to be rising, and unions are going to be getting stronger, not measured in tomorrow or next quarter, measured in the years and decades ahead. So one of the outcomes here is one of stagflation, and we are going to get into a period of elongated increase in cost, which will put pressures on corporate margins, which to me will lower the market multiple. And so that's in front of us in the years to come. It doesn't mean you sell your stock, folks. It doesn't mean you put your head in the sand. It means you're thoughtful about it. You recognize we're going to get into a difficult market. We're not going to start dancing in the streets and partying again. But understanding what's coming, especially if you're the custodian of the next 30 years of your life, of your do-it-yourself retirement account. If that is you folks, and I imagine on the 12, 13, 1,400 people that are on the call here today, that it's many of you, please take what I'm talking about to heart. Don't bury your head in the sand and go to cash. Understand what you can do to improve your situation. Okay, so important. So let me get into some of the Q&A that have come in, and then I'll try to answer as many online questions if I haven't already in my comments today. And in the pre-conference, I answered a lot of questions. Mortgage-backed security and REIT sector. So we've got an implied support for a lot of these by some of these programs. So Ryan, so it's a great question. But to me, there's still too much economic uncertainty that you're at the point in a MORT or REM holding, which is a broad spectrum of debt and equity exposure to real estate. We're not there where you can just close your eyes and just say, I'll come back in a couple of years and there won't be volatility. But the values are starting to be developed for sure. What we don't know is the extent of the downside, but Ryan, we're much closer to a low than we were at the ridiculous valuations we were seeing, months ago. So I would say I like it. Buy into weakness. Don't chase the strength here. There will be more pockets of weakness in front of us. Pearson asks, what are my thoughts on preferred shares and what are the risks? So depends what kind of preferred shares. The vast majority of preferred shares in Canada are these reset preferreds that are linked to the yield of the 5-year bond. And as yields fall, so if we're in an environment of controlled interest rates, of yield curve control, which we are going into, we are not going to see interest rates rise for years. 5 years, 10 years, I don't know, but we're not going to realize a lot of growth and value in them. The yields will be less than they were before, but they're still attractive yields within preferred shares. So if you're talking about the perpetual preferreds that don't reset and trade more like bonds, those are bond-like and more attractive in this environment, but probably closer to being fully priced. Also within preferred shares, they are junior on the capital structure to bonds and to equities. And in the companies that are going to have financial difficulties, I would just shy away from them, Pearson. David asked to take advantage of the coming recovery, and it should be substantial. Well, I disagree that it's going to be substantial. I do agree that technology is going to be a leader coming out of this. And so simple tracking stocks for the NASDAQ, not for the S&P 500, it's not a tech leader. I would go into some of the technology ETFs that I've highlighted, some of the subsectors that I really like coming out of this, cloud and 5G and those kind of things, Internet of Things, rather than the broad NASDAQ. But ZQQ is the BMO Canadian dollar hedge NASDAQ exposure, very, very interesting to me. But I disagree that it's going to be substantial. It'll be substantial if we get cut in half like we have in every other major correction in the last couple of decades, but not from 2,800, okay, where the valuation is not attractive. I'm looking at adding gold. So I talked about gold. I love gold. I think it's a great asset class. It's going to be volatile. There will be periods where markets, equity markets rally, where this sells off. But the largesse of the government dole and the size of the monetization that's going to be needed in the years ahead of us is monumentally bullish for gold. We will pause against the old highs, but I'm almost certain we will retest 1900 plus, which were the highs from 2011. We will stall there for a while, but I envision a world where we go through those levels. You're welcome. Thanks again for doing this series. What do I think of Brookfield Asset Management? I think Brookfield are excellent operators. And it sounds like you're seeking dividends here. I don't love the mutual fund business. Someone who runs a mutual fund. I love the ETF business, the wealth management piece. So Brookfield has lots of pieces to it. They're great, tremendous infrastructure operators, but we saw a 40 or 50% haircut in Brookfield Infrastructure Partners. Brookfield in generally are great operators. As a management team and business, I like the company very much, but I wouldn't be chasing strength here in just about everything. We'll get opportunities to buy these things on weakness. U.S. employment numbers, analysts seem to think the numbers have peaked. Max seems like, well, so there are some limitations to technology. There's only so many hours in the day people can get online and put their things in, and there's more to come here. You saw a slightly lower number today than the worst expectations. There are in some states, I'm told, people in the gig force that now qualify. There's no box for them to tick online, so they can't yet apply. So some of those things are very, very real. But we're going to see for weeks and weeks and weeks and weeks. And even so, when things still reopen, you're going to see mass layoffs. It's not going to be 5 million a week. It'll trickle down, but it'll be into the hundreds of thousands, but it'll still be going up. And at some point when we fully reopen and furloughs get waived and people come back to work and get off the registers, ultimately, the unemployment rate in the US is going to spike at somewhere over 20%. I don't know what the number is going to be. No one can guess that. Someone from the Fed said it could be as high as 30 or 40%. I don't know. But what I can tell you is it's going to take years to get back to 4 or 5% or the 3 handle that we were at only a month ago. So it's going to be long term. I don't know if that answered your question there. I suggested bonds. So I talked about bonds already. I talked about, would I buy them as a hedge? So I don't own them right now because I do think supply is an issue here. And I have to weigh that pending trillions of supply against how much the government's going to have to buy and the Fed balance sheet's going to have to expand. But very, very realistically, the Fed is going to have to take down another $3 to $4 trillion worth of corporate mortgage and government debt in the next, this year. And it's a monumental amount. And to the degree that puts pressure on the bond market, we're just going to have to see. Buy dips, definitely. Chase rallies, I'm not sure at this point, and I don't have exposure. So I hopefully that answers your question. You can do it with options on TLT, and I would recommend, if you know anything about options, to have a look at buying some call spreads as a way to play that. Pay for those call spreads by writing a put at the level that you would otherwise like to buy TLT, and whether that's on a technical or fundamental yield basis, you would have to decide. Maybe that's a topic for another day on a BermansCall episode or one of these. I'm sitting in cash, and I've some of your recommendations are in USD. So there are just not at the moment a lot of great niche ETFs. Evolve ETFs has some of these. They've got the cars, automation, they've got the robotics, they've got the cybersecurity. So I would look at Evolve ETFs in Canada for some of those niche plays. But outside of that, there's not a lot. And if you want to be in US dollars, yes, when things recover, you're going to lose some money as the Canadian dollar strengthens. I don't have a solution for you. There just isn't any. But if you want exposure to the NASDAQ, you can buy the NASDAQ currency hedged, right? ZQQ is a good way to do that in the BMO world versus owning the US versions of that. So Tommy, I think that kind of answers. What indicators tell us the market bottom and an uptrend is happening? So there's a lot of different ways. People have their favorites. A lot of people look for these capitulation days, a series of 90% down days, exhaustion and selling, selling stocks down versus up is hugely skewed, massive amounts of volume on the downside. Those are very, very helpful to mark a bottom. Very clear there, Al, a bottom, not the bottom. The bottom comes when we stop making lower lows on periods of capitulation. And then you get confirmation when we start making higher highs. I don't think we're there yet, Al. This is a reflexive rally in my mind. People are getting very excited about a cure. They're getting very excited about reopening. They're willing to bid stocks up, but their stocks are not cheap, and fundamentals aren't there yet for me. But make no mistake, there's billions of dollars chasing fast here, and we will get violent swings, and that's what elevated VIX levels are all about. How safe are Canadian pipeline stocks? With WCS trading at $5 a barrel. So I have exposure. I get that exposure through ZWU, which is utilities, pipelines, and telcos, covered call overlay. I like that as a defensive holding. It got beaten up with everything else, guys. But I like that way to play them. They're great companies. We don't have to worry about them. In general, they're well capitalized and financed. But if prices stay this low for long, there's going to be some dividend cuts. Okay, so you don't want to look at a yield today of something saying it's paying 12-15% and think you're going to get that in the future. You're most certainly not. Those dividends will be cut anywhere from 50 to 80 or 90%. We've seen some already. When things normalize and they have a sense of their cash flow and they're not in cash preservation mode, those yields will come back. But there is no political support under the Liberals for pipeline expansion, for what Canada needs to see big investment in that space so that WCS is not permanently suppressed compared to world oil prices. We need TMX, we need distribution capabilities to Eastern Canada. Keystone XL, the US doesn't need our oil. The US now exports more products than they import in terms of refined products and everything else. We need to sell our products to Japan and East Asia. There's no other way to say it. Until the Liberal government supports pipeline expansion, really, not just squawking about it, really puts their heart and soul into getting TMX built, we are not going to see WCS prices recover relative to WTI. And in that version of the world, I would prefer to invest in US energy as opposed to Canadian energy. Sorry, Alberta, but I think, I've always been a plain vanilla guy, right or wrong in my opinion sometimes for sure, but that's how I feel. I have cash waiting on the sidelines to jump in. Great, good opportunities there. I'm looking for dividend ETFs to get steady cash flow. Should I do it in stages? Albert, you always should leg in. Dollar cost averaging. When it's in the midst of panic, that's the time Warren Buffett steps in. That's the time you nibble. As the markets have recovered here, this is when people feel more comfortable getting back in. But from a risk return standpoint, this is not the good time to do it. You got to do it. People say don't try to catch a falling knife. Yeah, for sure. But when you understand the fundamentals of bear markets, so when there's no recession, the average correction 13.5, you got to be a buyer. When there's a recession closer to 30, you got to be a buyer. Doesn't mean the bottom's in, but you got to be a buyer. And I was in my funds. And I was lifting hedges and I was putting money to work in areas where I wanted to own at that time, given the set of circumstances and my best understanding of the world. And now we're hedging things up again and waiting for the next, sell-off, which I think will come. George says they're stopping. There's all kinds of policies, George, that they're looking to implement to help mom and pop. And is it a signal the system has collapsed? And yeah, it's a failure not to plan for disaster. And there's all kinds of hurricane relief and but the hurricane's coming and people, they stay in their homes still. So you're never going to be able to prepare for a 1 in 100 year thing. You're just not. But the fiscal largesse, the size of the debt, the fact that central banks have to do all these unprecedented amount of things, to me, tells me fundamentally the system is weak, and it tells me we shouldn't be paying a strong growth multiple in a low growth world. So it hasn't collapsed. But it's fragile, George. I'd be lying if I didn't say I thought it was fragile. But we know that, and it doesn't mean you shouldn't be investing. You should just know how to invest for the environment that we're in. And sitting in cash isn't an option. Okay, it really isn't, folks. Learn your tools and know how to use them. High frequency trading, dark pools, and other automatic trading systems so prominent today are investors forced into shorter time frames because of zero commission trading. So yeah, absolutely. The turnover on the average ETF is like 4 days. So, when you factor in all the noise in trading. But for the average investor, don't think about that. Don't try to compete with that unless you're sitting on the screen day trading. And if you are, good on you. But that's not the world I live in. I think strategic, I think value. I think growth at a reasonable price. And I don't care about the noise. I know it exists. Don't let it bother me. I don't try to compete with it. I try to understand it, and I try to how to work in that world. Lothar, I hope that answers your question. So we got about 10 minutes left. Let me see what's come in online here. If I can answer some of these. Stocks were very overpriced, seem to be bouncing back. Will we ever see a return to fundamental? Well, Tom, that's a great question, and I've addressed some of those points tonight. Again, in my version of the world, which I think is a relatively humble and sane and thoughtful view of the world, we're going into an environment that's going to be very, very difficult. The band isn't stopped playing. It's still playing, certainly at the government level and at the central bank level. And that can still boost things for a while. And we will get these face-ripping rallies, absolutely. But fundamentals are fundamentals. And this is where I talk about earnings and what should we pay. And so I'm very highly confident that we will see a fundamental rationalization, Tom, over the next year or two. And how that plays out is probably something like what we've seen in the past, where the markets step down and have these big rallies and step down. And those are very tradable and profitable if you understand your tools and how to use them. Understand that you're not going to get it perfect, okay? So should you be all out or all in? The answer is no. So for me, when the greed factor is higher, I have a hedge ratio, and the size of that hedge ratio is a factor of my version of potential return, i.e. markets going higher, or the risks of a correction between now and whatever time frame I want to protect in. So that's how I think about Tom. Some of the smartest hedge fund operators in the world think the same. George Soros does the same. When Soros funds were public, you could see the hedge ratio, the degree that he buys puts or uses futures or uses some derivative strategy to lower the risk. Do you think Ontario Teachers Pension Fund or the Canada Pension Fund swings around the stocks and bonds in their portfolio? No. You know what these guys do? They do a swap. They go to a bank and they say, we're 60-40 generally because that's, what we kind of target. But we think there's a period of risk coming. So I want to swap 10% of my equity return on the TSX with 10% of the bond return of the TSX bond index. Swap, done. I pay a fee for that swap, and now I'm 50-50. Now, the underlying dealer that does that trade or series of dealers will use futures contracts and other derivatives, and they'll hedge their risk away, and they'll take their swap fee. And then after every month or quarter goes by, they exchange the difference in returns between those two. And that's what a swap is. The swap market, the derivatives market, is the biggest in the world. It's massive. Warren Buffett called them weapons of mass destruction, financial weapons of mass destruction, because when they get unwound and there's leverage involved, that's when there's no bid for markets. But this is how markets work. So great question, Tom. Great question. Fantastic. What the heck do I do with these preferred resets? I own some of them too. I own them for their return and their yield. And hopefully some growth, but we're in a world where those strategies are not great. And I've been selling them into strength when we get these rallies. And Doug, I feel for you here because I've owned some of those too, and they're not impaired assets, but again, you got to understand how they work, and into periods of strength. So until interest rates start to rise again. And what I've said here, potentially with the yield curve control that we're going to be seeing for the next number of years and perhaps 5 or 10 years, as we get through this stagflation and funding of all this debt and infrastructure bills and the next bill and the next bill that the markets are cheering, how are we going to pay for that? And so interest rates aren't going up for a long, long time. But eventually, we are going to get inflation. And they are going to have to peg interest rates lower so that bond yields don't go higher. And they're just going to have to monetize that debt like they did. Now, coming out of that period, we had a massive period of growth in the 50s, 60s, 70s, and into the 80s and 90s. And that's when the world was a lot lower and the demographics were favorable, and we were able to grow out of it. We will not grow out of this time around. The fundamentals of growth are not in front of us. They are in emerging markets where the average consumer is in their 20s. But when the average consumer is in their 40s and the average retiree, which is 35% of the population, is 65, thinking about their money having to last them for 20, 30, 40 more years. And with some of these genetic cures, maybe people are going to be living to 120. The idea of being frugal is going to be part of everyday life. If you don't think the millennials that have just lost their jobs and can't pay their rent anymore and don't, pulling their hair out here, aren't going to be scarred for a long time. I use the analogy, and then I'm going to wrap with this. I use the analogy of what happened to me years ago. I was so excited to buy my first BMW. I'm a very goal-driven person. And I was so excited because I grew up in near poverty, and those of you who know some of my story know that. And so it was exciting to me to have a status symbol. It was a thing for me. And so when I bought my first BMW, I was so excited. And so we drove, the time we were in Boston, we drove from Boston to Montreal to see my in-laws. And my wife's grandmother, God rest her soul, a lovely woman who was ripped from her home in Warsaw, Poland, during the uprising of the Nazis, lost most of her family, saw me with a German car, and didn't speak to me for a year. And she was scarred for life by that war, that thing that happened to her. And I'm not saying this is a war like that, but this is a war. And people are going to be scarred possibly for life, and remember this. And they're going to be more frugal. There's going to be more rainy day money. There's going to be a higher savings rate. And I'll finish on that. And so I'm going to just wrap here with a thank you to everybody, and a shout out again to our sponsors, and a plea, if you will, that folks, if you need some help with this, and whether that's with the portfolios we manage for BMO, check out ZZZ portfolios, or if you're qualify for our custom private client portfolios, we would be happy to work with you. If you need an independent financial plan, by all means, tune into Monique's webinar next week. Go to youpotential.com for information about that. For the ladies out there who want a different tilt and learn about finance a little bit differently, Golden Girl Finance is a great resort for you. And for the investment people out there, professionals, have a look at our Q Wealth platform. Folks, if you've learned something tonight, if we've helped you, I'm asking for your help. Jared at the top mentioned our 2 charities. We do these things because we want to help, and we're asking for your help. Cancer research at Sick Kids Hospital, wonderful cause. We know there are many, many causes. $20, $50, $100. There's been some people who have dug deep, $200, $500, or for dementia and Alzheimer's research at the Baycrest Foundation. These are 2 organizations that are world leaders in what they do. And Jared and I are intimately supportive of them and have very close connections to the cause, give our time and money to these organizations organizations. And so if you can help us out, there will be links in the email sent to you in the feedback section. Please, please, please consider making a donation and help supporting one of our charities. It is time. It's 8:30. We hope you've learned something tonight. Thank you so much for your time this evening. We will see you next Thursday. And tomorrow, remember, BermansCall special edition, Friday at 4:30. Remember, Trudeau is on at the 11 o'clock hour, and until that changes, BermansCall is going to be kind of fit in wherever we can fit it in, kind of thing. Thank you very much, everyone. Enjoy your evening and be safe and healthy.